Hi, thanks for joining me. My name is Eric Brown, and I'm an Associate Portfolio Manager at Graham Wealth Partners, which is a part of Canaccord Genuity Wealth Management. As a reminder, if you like our content, please like it, subscribe, comment. We'd love to hear from you. If you want more details, you can go to our website at www.grahamwealth.com. Today, I'm excited to talk about borrowing to invest. With interest rates at a very low level, I'm getting all kinds of questions from a lot of people asking me if they should borrow to invest. And typically that means taking money out of their home and getting a line of credit and putting it back into some type of investment. I don't know if you knew, but the prime rate, which is what the banks use to determine their interest rates, is at not quite an all-time low, but the second lowest point it's been in history, second only to 2009 after the financial crisis. And what that means is that it's really cheap to borrow money. Now the big question, the first thing that you need to consider is, should you actually do this? I know I can show you some numbers and, oh yes, it makes sense and it's wonderful and it's going to be great, but can you personally handle borrowing more money? So today I'm going to give you an overview of the pros and cons and things to consider when you do borrow money. So let's talk about the advantages. When you borrow money, you are able to earn a rate of return that ideally is higher than the interest rate that you're paying. And that's really what you're looking for. So if you borrow money at 2% as an example, and you get an investment return on that money of 5%, then you're better off, and over time you will grow and it will make you money. The second point that you can consider is that you can borrow that money for investment if you're clear that it's for investment and it's not in a registered plan, so a RSP, a TFSA, or an education plan, then you can write off that interest on your taxes. So if your interest rate is 3%, you can claim that and multiply that by your marginal tax rate, and then you will get a tax savings on that. So what that means is if you have a lower interest rate minus the tax credits, then the investment return that you need from your investments doesn't have to be as high. Or if it is as high, then you get to keep more in your pocket. So those are the two major advantages of borrowing to invest. You can leverage, you can take advantage of having more money than you did originally by borrowing, and it can allow you to grow wealth over time. The disadvantages of it are what happens if your investment goes lower than what you borrowed. Meaning, if you bought $100,000 worth of investments and you borrowed $100,000 to do that, but your investments, which maybe let's say they're in the stock market, what if those investments becomes 90,000 or 80,000 or even 50,000? What are you going to do? The question is, you really have to ask yourself is, can you handle that? Are you going to panic? Are you going to lose sleep? Are you going to worry about it constantly? Or is it something that you're comfortable with and you're willing to ride out the fluctuations in whatever investment you're in, the market or real estate or whatever it is that you bought? And that's a big thing, because if you feel uncomfortable borrowing more money, then that should be the first warning sign. Do not do it. The second downside is that you will have to pay the money back. And it's something that you don't know what the future holds. You don't know what the investment's going to do. At some point it could be down. So you might get to a point where you actually lose money on your investment permanently. It's never coming back. It's not just market fluctuations. It's gone. And you have to have the capacity to be able to pay that money back or continue to pay the debt. And it's really, again, down to your comfort level and whether or not you want to do that. So there's some key things that you have to remember. You have to remember that, yes, there is an opportunity for upside. Yes, there is an opportunity for investment gains, but you do have to be aware of fluctuations, both in the markets, but in the interest rates. So if your interest rates go up, that's something also that you do have to be aware of too, that if you borrowed at 3% and all of a sudden the interest rates go up to 6%, are you able to manage that? Will you be able to support that and fund that through the income that you generate and through your employment income, or is that going to cause a problem? If you think it's going to cause a problem, well then maybe borrowing to invest is not for you. And I'd say that typically the people that are borrowing to invest are those that are able to take risk, those that have a long time frame, and that if the market does go down, that they have the time to recover it. So it's something that's based on your individual circumstances. So if you're considering borrowing to invest, make sure you give me a call. We can have a conversation about it, look at the pros and cons for your individual circumstances. I'd be happy to talk to you. Again, you can go to our website at www.grahamwealth.com.